Okay, let's recap through what has happened in the markets and the close. The Dow closing up or finishing off above 8,000 points, higher by almost 500 points, but still down for the week. The same thing with the S&P, higher by, as you can see, 6.3%, trading at or closing at 800. Pretty much 800 even. So we're seeing this. We saw this late day rally on the back of this news, of course, that President-elect Barack Obama has indeed nominated Tim Geithner of the New York Fed Treasury Secretary, and that official announcement could come on Monday. Well, let's bring in our featured roundtable. Mark Pato is U.S. market strategist at Cantor Fitzgerald in Reno, Nevada, and Jack Malvi is a fixed income strategist at Barclays in New York. Jack, perhaps I could start with you because I did notice that despite the fact that we saw a major rally in equities on the back of this news, bond markets didn't do a whole lot. I mean, they were down already. But why is that?
Well, I think the bond market was chugging into a weekend close, and I think that in the bond market, maybe it was so well expected. I'm not sure why it would be any revolution in terms of valuations. You
think it was well expected,
yes.
Mark?
Well, I think that any of the choices that were being bandied about, whether it be Volcker or Summers or Geithner, that all three would have been something positive for the market. The market just wanted to get it out of the way, especially getting it before the weekend. I think that was important. But this flight to safety has been going on for several weeks and got intense in the last couple of days.
Well, Jack, I wanted to get back to you because do you think that this means that this flight to safety we've seen, of course, we had record yields, low yields yesterday on Treasuries. I mean, is this flight to safety going to ebb with this type of news?
Well, I don't think just on this news alone, but I think in terms of developments over the course of the next few months here, we probably have not seen the conclusion of capital preservation, flight to safety movements in the market.
What do you think Geithner is going to have to do to restore that confidence then?
Well, I don't think it's him alone, certainly. It's the Obama administration and also the Fed. And I think there'll be a variety of programs. Fiscal stimulus in early 2009, auto bailout, let's return to that, see where that goes. A whole host of measures are likely to come out of the Fed as well to get things rolling again.
Well, I mean, we've had guests on our program, on my program earlier in the morning, saying that fiscal stimulus is going to be the biggest thing accounting for the markets. Mark, is that something you agree with, or you think it's got to be a whole host of measures?
It will have to be a whole host of measures. We're going through a massive deleveraging, and it's not just a recent event. We probably got to this point over the last decade of leading up and building into this position. So as they delever the financial institutions, they're going to have to flood them with money. I think the biggest problem with the market over the last week was that Paulson said he wasn't going to go after that $350 billion. He needed that in his pocket. We definitely needed that liquidity, and we needed a stimulus package also from Congress.
Okay, let me bring in our third guest, Peter Schiff, who oversees $1 billion as president of Euro-Pacific Capital. Just managed to rush in on this Friday afternoon, Peter. Listen, I was just asking our other guests, Jack Malvi as well as Mark Pato, about this announcement about Tim Geithner. We're seeing a reaction in equities, not so much in the bond markets. It's partly expected. What is your reaction to this? You're a bear in the market.
Yeah, so. Look, I think it's a short covering rally. I don't think it matters who they put as Treasury Secretary. The economy is in terrible shape, and everything the government is doing now and everything the government is likely to do when Obama takes over is going to make the situation worse.
It's going to make it worse.
Of course. Remember, we got into this mess because we borrowed and spent too much money. The solution isn't going into deeper debt to encourage Americans to spend even more money. We need a serious recession in this country, and the government needs to get out of the way and let it happen. We need higher interest rates, we need more savings, we need more production. What's happening right now in the economy, this is not the problem. This is the consequence of the problem. The problem is that for years we borrowed money that we couldn't repay. We borrowed money to consume. We ran up trillions of dollars of debt, and now we're too broke to pay it back. And we have a phony economy that's been propped up by foreign governments and foreign workers who have produced the stuff that we bought and lent us the money to buy it. We need to recreate a viable economy in this country again, and unfortunately, that comes with a lot of pain, and we have to suck it up.
Mark, Jack, you care to disagree?
I disagree with a lot, but I'll stop.
No, go ahead. That's why you're on. What do you disagree with most?
Well, I don't think that we need to do nothing. I think that that would be irresponsible because I think government policy is needed to cushion the downside here. And I think on both sides of the aisle in Washington, it would be the case that, as shown with even the Republican Bush administration, they're very aggressive and active in trying to cushion that downside.
Yeah.
I agree with Peter that certainly there are areas that we've been irresponsible collectively over the course of a very long period of time, but to effectively do nothing, probably not a great idea.
Yeah, because I've had Jim Rogers on my program a lot, and he sounds the same tone as you in many ways, saying that we should do nothing. The U.S. should do nothing. And is there no middle ground, though?
No. Remember, back in 2001 and 2002, I was highly critical then of the Federal Reserve and the government's attempt to mitigate that recession. Had the government done nothing back then, we would have had a worse recession, but our economy would be in much better shape today. The housing bubble, all this reckless borrowing and spending, all these bankruptcies now on Wall Street are a direct result of what the government did back then to mitigate that recession. And unfortunately, the government is now sowing the seeds with a much bigger crisis. What we're now setting up is going to be a currency crisis. It's going to be a run on the dollar. They're going to unleash hyperinflation in the United States, where consumer prices and long-term interest rates are going to go through the roof. And it's going to be much worse. Unfortunately, government policy can't help. It only makes it worse.
Well, there's a point there, Mark. I want to bring you in, of course, into this as well. But, Peter makes one point, though. We can't be bailing out every single company.
But we don't have money to bail out anybody. We're broke. We're borrowing the money from China. We're borrowing it from Saudi Arabia. We're running it off a printing press.
Okay, but Mark, I want to get your response, because obviously you disagree, right?
Yeah, absolutely. I think that this is the solution that you have to have is printing press. You got to print the dollars. I understand what you're saying. You're worried about inflation. The thing is the whole inflation of this was built up in the last decade. That's what spurred on this, using the derivatives, using the leverage. Look at it now like a dried up sponge. You got banks that are 30-to-1 levered. You could pour 20% into it and it would just soak it up. Nothing would happen. There would be no inflation. As long as you regulate and say, now you have to be 10-to-1. No more 30-to-1, no more 40-to-1. You got to be at 10-to-1. And they can add liquidity to the financial institutions and nothing would happen. They would have to hold it in treasuries and it wouldn't make a difference. But we have to get back down to that 10-to-1. And that's really where this is going. I completely disagree. We're not facing inflation. We're facing deflation.
We let them go down to lower ratios by letting these companies go bankrupt. That'll wipe out a lot of their debt. When you're printing money, that's the definition of inflation. And what's going to happen is the dollar's going to fall through the floor. Asset prices are still going to fall, but consumer good prices that Americans pay when they go to the supermarket, they're going to go through the roof.
All right, Peter, Mark, Jack, just hang on. We'll be back after this break. Okay, we're joined now by our roundtable. We've got Cantor Fitzgerald's Mark Pato, and with a fixed income perspective is Barclays' Jack Malvi, and Euro Pacific Capital's Peter Schiff. Now, of course, equity markets have not been the only markets that have been on the move. We've had gold, the dollar, also oil making a lot of very dramatic movements. I want to start off with gold, though, because I know, Peter, being that you're a bear in equities, you're a bull on gold. Some might say, though, that it's not going to last, particularly with some of the deflation concerns.
Well, look, we've been in a bull market in gold since 2000. We've been in a bear market in stocks since the same year. And I think in this recent correction in the price of gold, what's amazing about gold is how well it's held up relative to other commodities, relative to other currencies. Gold's now at a record high against the Australian dollar, the Canadian dollar, the South African rand. Gold's, gone up dramatically against oil, against industrial metals, against agricultural commodities. So I think there's been a stealth run in gold over the past few months, except when you're looking at it through the prism of the dollar, you don't see it. But this dollar rally that we've had is phony. The next major move in the dollar is going to be a collapse.
Why do you say it's phony?
Well, because I think it's just due to deleveraging. Americans are having to sell everything they own to pay off their debt, and they're selling assets at fire sale prices. They're moving into the dollar. But that's not going to last. Everything that we are doing right now is so fundamentally destructive of the value of the dollar. And I think it's going to be a crisis. The dollar is going to drop like a stone.
Jack, you think the dollar is headed lower, despite the rally we've seen on deleveraging?
Oh, in the near term, probably gets a little bit stronger because we're not just alone in terms of having tough times. There are tough times in Europe. There are tough times coming in Asia. So in some ways, it's a tough currency except for all the rest. So it's a year from now. I wouldn't be surprised if the dollar is a little bit stronger than it is today.
But you got to look at the difference between why we have tough times and why they do. We have tough times because we're broke. Their tough times are because they loaned us money and we can't pay it back. But fundamentally, the creditor economies are in much better shape. They have sound economies. They can absorb these losses. We're broke. And when the world cuts us off, we have a major economic collapse coming because our phony service sector economy won't function anymore without foreigners lending us money and supplying us with goods.
Well, Europe hasn't really lent us that much. Parts of the Middle East, as you know, are really having a tough time right now as well. So
well, our biggest creditors are in Asia, of course, in China and Japan and Southeast Asia. But that's going to stop.
Well, Japan is in recession now, too.
Well, Japan is in much better shape than the United States. They're the world's biggest creditor. They have a balance of trade surplus. They have a high savings rate in Japan. Japan's in great shape. We're a mess. We're a complete disaster.
Not in the same camp.
Well, I mean, that's why I was able to predict everything that's happened for the last year or two. I don't know what you were forecasting a couple of years ago.
Mark,
well,
jump in.
You know, the dollar actually has been in a decline for the last 6.5 years.
Exactly.
The dollar index falling. And I think that was a concerted effort by the administration to devalue the currency to get us on a level playing field with a lot of our foreign competitors so we could bring manufacturing back. So I do think that we're going to probably go down and test those lows on the dollar index around 72. I don't know if I want to call it a collapse. That's the only problem. I don't want to go down the road of calling for disaster and an implosion of the capitalist system just to prove a point.
Not
I
the
think the dollar's
capitalist
going to
system.
be weaker.
We're not very capitalist anymore. We're more socialist. But I think the dollar index is going to hit 40 and potentially maybe even as low as 20.
Mark.
Okay, yeah, see, I wouldn't go that far to say that.
Well, I wouldn't. I just did.
Okay, let's get beyond that. But Mark, you know, in terms of the dollar, of course, we talk a lot about that in relation to the commodities. In terms of energy shares and oil prices, I mean, do you see how's the dollar going to affect oil going forward? Because we've seen a big drop already.
Well, as I said, I think that once we get past the end of the calendar year, I think there's a lot of pressure on the calendar year right now, pushing up the dollar, pushing down the price of crude, as a lot of these funds, these hedge funds, look to liquidate what they can, especially what's liquid, hitting oil, hitting gold. So we're going to see a rebound in gold and oil and a depreciation of the dollar in the first quarter. So I think that there's a very playable trade on a short-term basis right there. So the end of this month, I think, is going to be an opportunity, and 2 weeks before the end of December.
Okay, Peter, Mark, hang on, and also Jack will be back with you. We're going to have more. Let's get back to our featured roundtable. Mark Pato, U.S. market strategist at Cantor Fitzgerald, Jack Malvi, fixed income strategist at Barclays, and Peter Schiff oversees $1 billion as president of Euro Pacific Capital. Jack, let me start with you this time. Getting back to the bond markets and treasuries, of course, we've seen a whole lot of buying. Some would say that the market there, treasuries are now overbought. I know Peter thinks that they're in a bubble. What is your view on this?
They're very rich as an asset class. I think that we've got more easing from the Fed likely on December 16th and again in early 2009. This flight to safety, capital preservation trade likely will drive medium and long end yields a bit lower than where we are today still over the course of the next several months. But if you look out a year or two, the combination of tremendous supply and hopefully economic and capital market normalization will drive these yields back up higher. I think strategically the bond asset class is really not a place for a great overweight.
Right, you wouldn't be buying into that. Peter, you agree?
Well, I agree, but I think there's a lot more risk. We've had a bull market in bonds, since 1980. It's now in the manic stage. I think when this bubble bursts, we're going to take out the lows in the bond market from the 1970s. It is going to be a bloodbath in bonds. And not only that, not only are bonds going to plunge, but the dollars in which they're denominated with are going to plunge too. So people are going to get wiped out in treasuries. They're going to lose almost all their money. Or their purchasing power.
Yeah, and obviously, bond markets being very affected by what the Treasury is doing. We've been talking about the economy and, also about the Fed. Jack was just talking about where he sees Fed rates going. Mark, I want to bring you back into this conversation because if the Fed continues to cut rates, and Jack just saying that very likely to, is that going to help restore some more confidence in the markets, or will it do nothing?
I think that in terms of the markets, it's not going to be the one thing that's going to restore confidence. There's got to be a lot more that's going to come into play, and cutting rates here is only creating a wider spread for those that are borrowing against it, borrowing at the Fed window. So the idea is to try to help bring that money in, get liquidation in there. But ultimately, I agree with both Jack and Peter that we're going to see higher rates, and the 10-year probably closer to 6 or 7%. Hopefully not the disaster that Peter's calling for.
Well, the big problem is, right now the Treasury is benefiting.
But in that direction, okay, we're going in that direction.
The Treasury is benefiting because everybody is focusing on default risk, and nobody believes that the Treasury would default, and so everybody is buying Treasuries as opposed to corporates or anything else. But the real risk isn't default. The real risk is that they pay you back, but they do it with a printing press. They give you money that has no value, and that's what's going to happen.
And I don't care if the hyperinflation scenario you're talking about.
Our bonds are rated AAA. They're junk bonds. They're as AAA as the subprime mortgages were. Stay away from them.
Okay, I want to get to back to the equities because we were talking ahead of the break about where's the bottom. Mark, I want to get back to you because you're the equity strategist. Where do you see a bottom in this market?
You know, like I started to say, I don't think that it's a matter of price, because what's driving the market down right now is not valuation. It's not the recession. You know, what's driving, it's not even the technicals at this point. It's actually that there's redemptions, liquidations, consolidations, margin calls, and it's causing an undue spike downward. And since we don't have a lot of visibility in these hedge funds, we don't know how much redemptions they got. You look at the moment this sell-off started, it was November 15th. That was generally considered to be the drop-dead deadline for if you want your money back by December with these hedge funds.
Yeah.
So, you know, obviously that's what's been coming in. They hit the back hour of every single day as they try to get more cash in their portfolios. When that stops, then I think it'll end.
Yeah.
And like I said, there's 2 time frames I aim at. The end of this month and 2 weeks before December. That's your typical tax loss selling period.
But you don't want to peg a time, though, where you think you see a bottom.
Look, I think, this is a major bear market that began in 2000. We're 8 years into it. I think there's another 5 or 10 years minimum left in this bear market. You know, the Dow was worth
5 or 10 years. Did I hear you correctly?
Yeah, the Dow was worth 43 ounces of gold in 2000. It just went below 10 ounces of gold today. I think it's going to hit 1 ounce of gold before it's over, just like the last major bear market. Remember, in 1966, the Dow was at 1,000. It was worth 20 ounces of gold. By 1980, the Dow was at 800, and it was worth just 1 ounce of gold. The Dow did not get back above 1,000 again until 1982. From 1966, major bear market. This one is going to be worse.
Where do you see the Dow? Okay, if you're talking about a bear market 5 to 10 years, I mean, where you see the Dow at 1,000 or what?
Well, I don't think it's going to go that low because we're going to have a lot of inflation. But in terms of the price of gold, I think we can see stocks lose another 90% of their real value in terms of gold. I don't know where the nominal value is going to be. I think it might be somewhere between 4,000 and 6,000. I don't know when it's going to hit it, you know.
Okay.
But people aren't going to make any money in the general stock market.
All right, 4,000, 6,000 Dow, almost hard to believe. And you guys are staying with us after the break still, and we'll talk about that with Mark and Jack. We'll be back with Jack Malvi, Mark Pato, and also Peter Schiff here in the studio with us, with me, to talk more about the markets and the outlook for the markets next week and also by the end of this year. Keep it here. Okay, let's get back to our featured roundtable. Mark Pato, U.S. market strategist at Cantor Fitzgerald, Jack Malvi, fixed income strategist at Barclays, and Peter Schiff, who oversees $1 billion as president of Euro Pacific Capital and also is the author of Crash Proof: How to Profit from the Coming Economic Collapse. Jack, I want to bring you back in because, not just in relation to the bond markets, but what are you going to be looking for in terms of key events over the weekend and also into next week? Are you going to be looking for some resolution to Citigroup? And will you be looking also very specifically about how retail sales play out?
Well, really nothing specific over the weekend. I mean, of course, Citigroup, but it's hard to know the timing and the denouement of what's going to take place there. And yes, over the course of the next week, I'm sure, particularly this day, next Friday, we'll all be regaling stories about how Black Friday went down, and not just in the U.S., but around the world, about the sorry saga of diminished retail sales. We'll be looking at all the policy measures and continue to reflect upon what the new Obama administration means in the U.S.
Mark, what will stick out for you? What are you going to be looking for in terms of discussions about Black Friday?
Well, the expectations have already built in a really bad holiday season already. So It's all going to be a matter of degree and how much people reel it in. Breaking $2 on a gallon of gasoline is a positive, but it's been overlooked in here. Not that it's going to save the holiday season, but it might. All it needs to do is not be up year over year, but be better than the expectations. The expectations are so grim that any little uptick is going to be a positive story, and I think we're looking for positives out there right now. But like I said, there's so much selling going into every rally that it's really hard to get bullish.
Yeah, it's a low bar set for any type of satisfaction.
Yeah.
Yes.
Well, it's going to be more like a black and blue Friday, I suppose, and it's going to get a lot worse for the retailers. But that's a good thing. As we were taking our credit cards to the malls and buying imported products and running up these trade deficits and leveraging up our houses, that was the problem. The solution, of course, is that we stop buying stuff. We need to just remember it's the thought that counts. Americans need to stay home for Christmas and not buy as many presents. We have to start saving and digging our way out of this hole. Of course, that means a lot of pain for the retailers, but that has to happen. We need to shrink our retail economy. We need to get rid of a lot of excess capacity. We have more shopping centers per capita than any place in the world. We don't need it. We need more factories. We need more people making stuff. We don't need people buying stuff.
Okay. Jack, you get the last word. Let me ask you, we mentioned Citigroup. We talked about Citigroup. Bottom line, is Citigroup too big to fail?
You put me on the spot here. The reality is the government's behind it, so they're one of the 9 banks. Yes, they're too big to fail.
Okay.
Nobody's
Very
too big
well.
to fail.
All right, we'll continue this discussion at another point, but thank you very much to you gentlemen. That is Peter Schiff of Euro Pacific, as well as Jack Malvey at Barclays and Mark Pato of Cantor Fitzgerald. Thank you very much, gentlemen, for joining me on this Friday afternoon, and have a great weekend, everybody. Meanwhile, the